Hi everyone, welcome to today's video. So in 2023, almost every major government, all the major stock investors, all the major macroeconomists, they all agree on one single point, that in 2023, the macroeconomic risk is high, and as a result, the stock market risk is also high. I'm not going to alarm you and say that the stock market is going to fall or not fall, that is up for debate, but the volatility is likely to be high. Now, sitting at the top of this risk curve in the Indian equity ecosystem or Indian stock market ecosystem are Adani stocks. Now, why are Adani stocks risky? Take a look at this chart and you will see that the PE ratio of Adani stocks is very, very high. More importantly, take a look at the pace with which the PE inflation of Adani stocks has happened. Now, all of us also know that the debt on Adani stock is just going bonkers. Now, to help you understand this situation, take a look at this chart. What you will notice is that if you take a look at Adani Green, if you take a look at Adani Transmission, if you take a look at Adani Enterprises, the debt has increased this year also. Now, the future is that in 2023, it is expected that Adani Ji is going to do an FPO, follow-on public offer. Now, it is another fancy way of raising more money through the market. So, is this situation risky? That is the first question that you will have in your mind, and you might have a series of questions. The primary question being that if the Adani companies default on their debt, will it crush the stock market with it? How likely is the default scenario? And finally, is there something that you can do as an investor to lower your risk? Even if you are directly invested in the stock market or in Adani group of companies, it will impact you. These type of videos are unlikely to be covered by mainstream media. So do consider liking this video because there is a very, very high chance that this video will be taken down. So your support would mean a lot. Now, also some of you might be super scared that if the Adani stock bubble burst, my investments will go to zero. Not only in Adani, maybe the entire stock market will collapse. So is there something that I can do? Can I move to some asset class which is safer? Yes, that asset class is called as debt. And there is a type of corporate debt that you can buy of more stable companies. For example, Bajaj Finance is a good company. It issues its corporate debt and you get 7.5% return on that corporate debt. So if you trust these type of companies more, then you can consider investing in these corporate debt. How to do it? This is a general question that I get. So for that, you can go on Golden Pie, which is India's #1 bond investing platform. And there you can go and scout a series of different investment options as per your risk appetite. So with that said, let us kickstart our today's analysis. And the first topic that we are going to cover is that how risky are the Adani stocks. So the first data point comes from here. So you can clearly see that the Adani debt has been going up year on year. And if you just study the comparison from financial year 21 to 22, it has gone up for almost all its companies. So this is point one that you need to understand. Also, to help you understand the history associated with Adani Group in terms of debt, take a look at this chart. What you would notice is that the gross debt has constantly gone up year on year. I'm not showing you isolated data. I'm showing you data for almost the last 10 years. Now comes the natural question that, okay, fine, the company is taking more debt. Debt taking means that, okay, they are borrowing more money. But as long as they can repay that debt, they will be okay. And I completely agree with this. But in order for a group to repay its debt, what needs to happen? Number one, the revenue of the company should be going up. And second, it should translate into profits. Now, Adani Group is hyper complicated and it is very difficult to analyze individual level numbers for every single company. But if we study the financial ratios, then we will get a sense whether they are on the right track or not. So the first key thing that you will notice is something called as ROE, which is called as return on equity. And what you would notice is that the ROE numbers are generally following. Now, what exactly is ROE? So ROE is basically a profitability indicator that if the net income of a company is high for the same level of equity, then the ROE will improve. Whenever a company's ROE increases, it simply means that the company generally is becoming more and more profitable. But this situation is not playing out in Adani Group stocks as of now. Now, there is another ratio called as ROCE, which is called as return on capital employed. Now, every company has a cost of capital. Cost of capital means that, for example, if you go and take a home loan, then what do you pay? You pay an EMI. That is the cost of capital associated with taking a loan for you. So please rewind this section, you will understand it more. But I hope that you got the basic concept that what cost of capital means. Now, what is Adani Group's cost of capital? I will link it here. It comes out to be roughly 15%. Now, what is ROCE? ROCE is that the return on capital. So they took the capital at 15%, but what is the return that they are making? So in the past, they used to make like 3.7% return. Then it went up 5-6%. And now they are making 4.3%. So what does this indicate from a financial ratio standpoint? It simply indicates that the Adani Group is not utilizing debt as effectively as it should. Now again, if you just simply go through the numbers, there is a lot of finance that you can understand. I don't want to bore you with all these details, but I hope that I've given you the indication how Adani is currently using its existing debt. But if there is one key point that you need to understand from this brief discussion, it is this. So take a look at this snippet. What you will see is that Adani's debt has more than doubled in the financial year 2022. Despite the revenues going up by more than 75%, they are currently facing a profit problem. They are not able to grow their profit margins as of now. Now, one natural counter argument that I will get in the comment section is that, you know what, Adani ji is creating a lot of infrastructure. Yes, they will have to take a lot of debt to create airports, roads, this, that, and eventually they will start making money on it. That is correct, but here we are not speaking about a small company. This company has already created a lot of infrastructure that is already functioning and is giving them money back. So they should be able to utilize that money in order to grow their business organically, or at least some part of it organically. Right now, a major part of their growth is coming solely from debt expansion. Now your natural response might be that, okay, what is new in this? I'm hearing about Adani is expanding their debt for the last so many years. It hardly makes a difference. They have been growing. Their share price has also been growing. What is so new about this that you're talking on this video? Okay, so the new part is this. So next year, Adani ji is going to do a 20,000 crore FPO, and they are not doing QIP. Now you will say that, okay, what is this FPO, QIP? Why does it matter to me? It matters to you a lot. So please hear me out. Next 1-2 minutes are going to be extremely new for you. This is an information that you might not have heard elsewhere, but this is the corporate accounting that you should understand in order to make sense of whatever is happening on the stocks. So the first key point that you must understand is the difference between FPO versus QIP. Now, what is FPO? So let me explain that by using a simple example. So let's say that the current owners of Adani Group have 100 Adani stocks. They decide to sell 30 of these stocks. To whom? To new retail investors or current retail investors. Now that process is called as FPO, or follow on public offer. This FPO allows company to do what? It allows company to sell its existing equity to new retail investors. This is a very, very important point, because at the end of this entire exercise, Adani Group is going to get 20,000 crores. Now what is the meaning of QIP? QIP means qualified institutional placement. So the word institutional means that these could be FIIs, DIIs, big companies. They are institutions. So I am explaining all these hyper complicated things in simple language. Of course, for simplification purpose, I might not be able to capture the exact definition, but I will explain you the concept in principle. Here, big banks, for example, JP Morgan or Morgan Stanley, they will be given a block of shares. Here are your 30 stocks. Now you might say that, okay, what is the difference between this FPO and QIP? Well, in QIP, a big institute is involved. For example, recently you might have noticed that a lot of tech companies released their IPO, and the investment banks that were in the middle, and they also lost a bit of face. Whatever valuations these banks had done, they did not come out to be correct or even remotely correct. So this QIP is a more responsible method of diluting or selling your existing stocks for a company. Just a very quick disclaimer that selling stocks by a listed company, it is not illegal. It is completely fine. I am not against it. It is completely okay for a company to do it. But which method you are choosing, that becomes an important part. Now you might give me a counter argument that, okay, this is simply your opinion. No, there is data to back it up. And here is the data for you. So in the last 10 years, there have been just 4 FPOs in India compared to 150 rights issue. So we are not going into rights issue, what that means. And there have been 250 QIPs in the same period. So it is very rare that a company does FPO. They mostly sell their existing equity through QIP route. And this is the first time that Adani Group of companies is also doing FPO. They have never done it in their life. Now, so far, the biggest FPO in India in the last 10 years has been launched by a bank called as Yes Bank. Now, that FPO was launched in July of 2020, and take a look at the stock performance after that. Now, can something similar happen with Adani? That is something that only time will tell. I wanted to present this information so that you can understand these complicated financial concepts as well. Now comes the next natural question to this FPO, that where will this FPO money be used? Because that becomes an important driver, because if the company, even if you assume that it is doing FPO for the right reasons, and if they have very good plans to utilize that money, which can allow them to repay its debt, generate more profits, whatnot, then probably this FPO game might be fine. But let us quickly understand what Adani ji himself is saying, that where they are going to utilize this money. They are going to primarily utilize this money in building 2 additional businesses. And these 2 businesses are green energy business and digital business. Okay, so here is the major risk that I see with Adani stocks. Right now, the Adani group of companies are mostly into infrastructure-oriented businesses. For example, they are building railway, roads, whatnot. So all these are infrastructure-heavy businesses. They require debt No doubt about that. And this is an area where Adani Group has existed and has built some kind of expertise. They have been doing fairly well. But now what they have started to do is that they have started to enter into completely new industries which already have massive giant players. For example, if Adani ji is entering into digital enterprise business, if they enter into OTT platforms, if they enter into Amazon type of businesses, then do you think that Amazon is not going to do anything and Facebook is not going to do anything? Because think about it this way, that when it comes to infrastructure development in India, you're probably not competing against Amazon, Facebook, Google, these type of companies. But when you start competing against Amazon and Facebooks of the world, you have increased your competition and you are doing firefighting on a lot of fronts. So I don't know whether this is a sensible move. Now, when the FPO is generally launched, there is a lot of excitement associated with it because FPOs are usually given at a discount to new investors. So you will see a lot of positive commentary around this FPO. So this is a study that was done by Ken, where they have analyzed that even if you get a 50% discount on Adani stocks, then also it is probably overvalued. So this brings us to part 2 of the video that, okay, let's assume the worst case scenario that Adani Group defaults on this debt or lands into some kind of serious trouble. Maybe not now, maybe a couple of years from now. Then how would that impact India, the Indian stock market, and your other investments which might be outside the Adani Group? So let me have a brief conversation around that. So point number 1 is that I don't think that the Indian government is going to bail out Adani ji. It might look very ironic, but genuinely, I don't want to take political sides. I show you data, back it up with facts. I understand that all the friendships that might exist, but it will set a very wrong precedent if the Indian government decides to bail out Adani Group of companies. Why that is not done? For that, you need to understand the 2008 financial story in the US, and similar situations have played out in India. So take a look at this chart, and what you will see is that a bunch of companies were rescued by the American government, or they were bailed out by the American government post 2008 crisis. Go through the list and you will see one common feature. Now these companies were banks or finance oriented companies. Now with banks or finance oriented institutions, even NBFCs, now what they do is that they interlend to each other, and this is called as interlending of loans. For example, HDFC banks lends to ICICI Bank, ICICI banks lends to Kotak Bank. Now if one of these banks also have a problem, and if that bank defaults, the entire financial system of a country comes under risk. So this becomes a major issue for any government. Therefore in India we have a system called as systematically important banks. So these are decided by the government and are supported by the government, because with a bank or financial institute, a government has no other option but to bail it out. Otherwise the entire country's financial structure might come under stress. Now something very similar happened with the Yes Bank story very recently, that the Yes Bank was going under, but the government stepped in. It created a consortium of SBI led lenders, and SBI in a way bailed Yes Bank out. But if you consider the example of Reliance Communication, which was an infrastructure based business like Adani Group, it was not bailed out, it was declared bankrupt. So then comes the second possibility that, okay, if the Adani Group is not bailed out by the government, is there something else that the government can help them with, or the other banks can help them with? Yes, and that answer is called as restructuring of loans. So restructuring of loan, what does that exactly mean? Let me help you understand in a simple format. In very easy to understand language, let's say that Adani Group has 100 crores of loans. Then the restructuring of loan would mean that Adani ji will go to a bank. They will say that, this is something that I can't pay, so give me like some other terms. So the bank might say that, okay, that aapka borrowing rate we will bring down from 9% to 7% or 6%, whatever that rate is. Second, they will give them an extension. So all this can be done under restructuring. Now, will you and I as equity investors get to know this fairly quickly? The answer is no. We will not get to know this, because the moment such a information comes out in the market, there will be massive sell-off of equities in Adani Group, and the stock price will tank, and the valuation of the company will tank quite aggressively, and there will be massive concerns associated with it. So this type of information comes out at the last minute only, when everyone is well aware and only retail investors are not aware. Now comes the third point related to Adani Group's collapse, that in case the Adani Group collapses, then a bunch of banks could go. I'm saying could go. It will not definitely go, but some of the banks could go bankrupt, and the government might have to step up and bail them out. So this is first key dynamics. A related point is that the market cap of Adani Group company is so huge right now that a lot of related businesses will suffer, and a lot of associated companies, public sector banks will go under. AMC companies or asset management companies like HDFC AMC, Naam India, all these companies will have some kind of indirect exposure, and they will also take a lot of beating in the stock market. So it is very difficult for me to encapsulate or quantify the entire impact of Adani collapse. But to cut the long story short, there can be a massive correction in the Indian stock market with Adani Group's collapse. So this brings us to the final section, that what is it that you should be doing in case you are preparing for such a scenario. See, I'm not trying to make this topic political or trying to paint some negative picture about a group. I'm an investor who puts his own money in different stocks, different investment instruments. So I need to prepare for different possibilities. And given the level of debt this group is sitting on, it becomes very important for me to do some kind of preparation around it. So I will leave you with a few key points. Number one point is that please entertain all the possibilities. That is what any smart investor does. For me, that strategy is the diversification strategy, that right now I'm not investing hyper aggressively in the stock market. I am building some of my cash positions, diverting a bit of money to the debt market. Now, why am I doing it? Have I become pessimistic about the stock market? No, because I've already purchased a lot of stocks at very reasonable levels, and please go and check my videos from November onwards, and I keep on giving a lot of commentary on paid YouTube member community as well on daily basis. So you can check it out. And right now my position is fairly simple, that instead of investing quite aggressively, I have to build some of my cash position, because in case there is any kind of major issue that happens in 2023, at least I will have some cash to take care of that opportunity. Which brings me to point number 2, that in the long term, the Indian stock market is going to do fairly well. Whether the Adani group of companies do well or not, that is secondary. So I am a long-term believer in equities and stock markets in India. So I will continue to invest, keeping that long-term viewpoint in mind. Third, I'm not going to invest in Adani FPO. Why? Because I've already outlined the reason throughout the video. Fourth and finally, going forward, I will be reducing my leverage on public sector banks. Now, I've been one of the biggest supporter of public sector banks, invested a lot of money, made a lot of returns this year on PSBs, but I think they have a lot of exposure to Adani debt, and going forward, I would not be comfortable with it. So with time, I'll be lowering my positions on public sector bank and convert a part of that money into cash and wait for better opportunities. I hope you enjoyed this analysis. Do give it a thumbs up, and I'll see you soon.